Hello and welcome to BQ Prime. A very good morning to all the viewers. You're watching Stocks in Focus and I'm Hiral Dadia. We have been focusing on the real estate space as well. That has been one of the sector that has been buzzing. You have Mahindra Lifespaces as well that has reported numbers. Let's quickly see what the numbers look like. You've seen a revenue degrowth of around 75%. The net loss has widened as well. Though the sales value has gone up for the quarter, the collections have gone up as well. Let's understand from the management as to what's worked, what's not worked, and what's the strategy looking like going ahead. Joining us on the show is Amit Kumar Sinha, MD and CEO at Mahindra Lifespace Developers. Amit, good morning and welcome to the show, and a pleasure to speak to you as always.
Pleasure is all mine. Thank you for having me.
Amit, my first question coming to you is, has the quarter met your internal expectations? Because the losses have widened, the revenues have seen a degrowth as well. What is the reason for this?
Yeah, I think let me highlight two parts, the good and the part that you touched upon. This industry, the accounting standards, revenue and PAT, what you referred to, is based on percentage of, is based on the possession. So when you complete the project, then only you recognize the revenue. Some projects, because of approval and final occupation certificate from the for the relevant authorities, is taking some time. It's a question of time. It's deferred from quarter 2 to quarter 3, but eventually those revenues and profits will come. It's just a revenue accounting method that causes these numbers. As we look at the industry, the most critical measures are the sales revenue, pre-sales, which has been very healthy, despite the fact that we've had a few number that compared to last year, the number of launches this year were far and few. In H1, the H2 is looking very exciting for us. We have a number of launches planned, which will allow us to really scale our pre-sales revenue to much higher levels. And you'll see that momentum going forward in our business. So the pre-sales and collections, as you touched upon, are very good. And it will only get better with H2 launches. The revenue and the losses that you touched upon are a question of counting, which will get corrected or improved as in the subsequent one.
Right. So, Amit, would it be right to say that in terms of FY24, you will be ending the year in the black because 2 quarters of losses we've already seen. So, will the second half of the year make up for the first half losses?
Yeah. So our we are working very hard towards making it happen. Last year was a very good year for us, and we want to make sure we beat the last year numbers this year. So working towards that, and hopefully we'll have good news to talk about on those fronts.
Okay. So from here on, what's the trajectory looking like with regards to new launches, sales? How much do you think you will be able to actually clock in the remainder of the year?
Yeah, so publicly we announced 2 numbers, so I'll just stick to those. So for F25, not for F24, F25 we have given a guidance of 2,500 crore on the residential pre-sale side and roughly 500 crore for the industrial. So that's the number we have given, and we'll stick to that. And it will also be in line with how we see the market growth continuing the next few years, given the residential cycle. Longer term, we just in the last quarter, after I took over, talked about our scale-up plans for F28. So 4.5 years from now, we are shooting to have a thriving business, pre-sales of 8 to 10,000 crores. So 5 times bigger than what we were last year is our aspiration in the longer term.
Right. So clearly, I mean, if you see the trajectory as well, in terms of the top line, we've seen somewhere in that 450 to 500 odd crores in 2019, 2020, a dip that did come in 21, 22, 23, again, we've seen that upward trend that has come in. So I think, again, a 500 odd crore is what we've seen from a revenue perspective, even in terms of FY23. What is that number that you're eyeing in terms of the top line with regards to 24 then?
So, this is, we are not giving any short-term guidance. So you'll have to excuse me on that front because this is a business which is very lumpy and it's marred by approvals. So our goal is on the pre-sale side. Last year, pre-sales was 1,800 crores. Our goal is to improve on that. and FY25 numbers are 2,500. So that's how we are. You can put a straight line between last year and the next year and say, hey, this could be one of the probable scenarios that we want to target. My target is to make sure that what we have delivered, talked about publicly in the last communications, we stick to that.
Right. Overall, between the premium residential as well as the value homes as well, between the two, where are you seeing the traction and where is the focus going to be for the company like yours?
Yeah, so we are. So let me just clarify two things. First is compared to last year of 800 odd crores that we talked about on pre-sales, most of that has come from sustenance sales. That means actually 85% of 800 odd crores is sustenance. So only 100 and odd crores have come from new launches. So the mix will change significantly as we enter H2. We have 9 launches planned for this financial year. 3 have happened and 6 more will happen in the rest of the year. You'll see a change in the mix of the revenue of pre-sales revenue. As we touched upon the value homes and the premium, we are clearly seeing a huge demand on the mid-premium and premium segment. The affordable continues to be healthy, and we have multiple projects which are doing well. In fact, some of the projects are already sold out, and we've launched the new phases of those projects. So we continue to see healthy demand on that front, but mid-premium segment is really seeing a lot more growth. And post-COVID, we've seen a 63% improvement in the demand for homes, and we have seen a significant uptick in the what I call Dil Mange More. People are asking for 1 bedroom, segment is asking for 2 bedroom, 2 bedroom owners are asking for 3 bedrooms. There is a lot of demand for upgrading their homes, given the what we saw during the pandemic. So the demand from mid-premium to premium will continue to be higher. The affordable gets affected a little bit by the interest rates, but hope to continue the momentum in a steady pace.
Right. Amit, what's the plan with the Thane land parcel? There is an unlock that you've been looking at. What's the status on that one?
Yeah, so it's looking much healthier. We are waiting for the new IITT policy, which got announced in July, which is very healthy for us. It improved the FSI that's available to us to 15.5 million square foot, which is huge. But it's a very large parcel of land. It's close to nature. We don't need to use all the FSI. So right now we're in the process of getting final set of approvals, master planning, doing the concept design, etc., so that we plan to launch this in the next financial year.
Right. And very lastly, in terms of the leasing business as well, what's the roadmap looking like and how much do you think it will contribute going ahead to overall revenues?
Yeah, so leasing, great momentum in that business as well. China plus one, decoupling of supply chain, domestic consumption story is very strong. And you've seen how India has become so important for the global supply chain. And for many of the Western markets, we see both domestic consumption driven demand coming to our world cities and origins. We also see a lot of MNCs looking to participate in that. We should be able to meet all the needs that they have. The target we have is roughly 500 crore of revenue or sales, lease revenue every year for the next few years. It doesn't grow because you are constrained by the size of land parcels that are available. We want to make sure that that is a healthy part of our portfolio, given the gross margin it provides.
Right. So I think all of these aspects is something we will wait and watch as well. Thank you, Amit, so much for joining us on the show and sharing the views. So that's with regards to Mahindra Lifespace. Overall, if you go to see, it has been a weak first half of the year, but clearly, as the management has been indicating, it's mainly on the back of the financial numbers. Clearly, they are expected to make up for it in full year FY24. The vision is to grow more than 5 times by 2028 and aim a profitable growth of almost around 8 to 10,000 crore worth of sales by 28 is what they're looking at. In terms of the residential segment as well, the focus is on MMR, Pune, as well as the Bangalore regions, and progressing well with regards to where unlocking value for the Thane land parcel that they hold. They're pursuing opportunities in build to suit leased premises as well. So that is going to be one of the key components of their actual plan with regards to where leasing as a business is concerned. Very lastly, if you see between premium and value homes as well, clearly the premium residential homes, the total development footprint remains pretty strong. Completed is also strong. Value homes, still the development footprint is very small because majority of it has been completed, and the ongoing projects is higher in terms of the premium residential projects. So that's with regards to where Mahindra Lifespace goes. The revenues, which are down 75%, EBITDA loss of around 35 odd crores is what we've seen. And we have a net loss of around 19 odd crores, which is widened from a 7.5 crores that was seen as well earlier. But moving on, another stock that is now in focus is already a RITES. Let's quickly see what the numbers look like with regards to where RITES is concerned. The revenues have dipped around 11 to 12% in terms of where RITES is concerned. EBITDA is down around 24% overall. The margins have come in at around 23.7% versus a 27.5%. Now, overall, there has been a dip in terms of where margins are concerned, and the profitability has seen a dip as well this time around. The export earnings and the quality assurance revenue, that is one of the key reasons why we have seen a dip that has come in with regards to where the top line goes. And the dip in terms of profit has mainly been led by the decline that we've seen in terms of the top line. The change in the product mix is what has led to the moderation in terms of profit margins as well. So overall, these are few of the highlights in terms of where RITES go. We will be joined by the management as well to understand what it looks like going ahead, because overall, in terms of the order book as well, 5,529 odd crores is where it stands so far. Let's welcome in our guest, Rahul Mithal, Chairman and Managing Director at RITES. Rahul, good morning and welcome to the show.
Good morning.
Thank you for joining us, and always a pleasure to speak to you. My first question coming to you is, clearly, we have seen some bit of a dip that has come in this time around. What has worked and what has not worked?
As you said, it's been a tough quarter, and the two main challenges were the export revenue and the inspection consultancy revenue. So we had a dent of, if you compare quarter to quarter, year on year, a dip of about 75 crores in the export revenue because there's no order book which we had available now, and about 25 odd crores dip in the inspection consultancy business because of the changed, the order from Indian Railways inspection stream. So our threefold strategy to tackle this was in line. One was to increase the project consultancy revenue. The second was to diversify our inspection clients from non-IR clients, and the third was to aggressively try and get export orders. So all three seem to be on track, and we seem to be on track to tackle this challenge.
Right, but okay, so as you mentioned that yes, this year has been challenging. Clearly, what does this actually tell you from a FY24 perspective? Where do you see it? Because we've already clocked in around 580 to 600 odd crores this quarter. Does this say that we will be able to actually look at a 25 to, say a 2,500 to a 3,000 crore revenue number in terms of top line, and the margins can go back to that 27, 28% kind of trajectory?
You see, with the push on all the three fronts that I said, with the project consultancy revenue growing about 20% year on year, and even sequentially growing about 10%. Inspection business, the revenue growing about 7% sequentially because of getting more clients, even though with tougher margins. And in export, at least about 2-3 locations where we've emerged L1 totaling to at least about 1,000 crores plus, which we foresee getting an order in the coming weeks. these will all start generating revenue more and more in the successive quarters. So seen as a whole, this entire FY is trying to, hold on and stay on there, keep minimizing the damage, come back to the levels of FY23 to the extent possible. And I see an aggressive growth in the coming FY as these mature into finite revenues.
Right. And what's the status of the exports? How does that mix actually stand right now, and where do you see it moving from here on? Because that, as you mentioned as well, there is some pain there.
Yes, so see, the order book, as I said at the beginning of the year, was only about 100 crores. That was the balance of the old orders. That has all started now. The deliveries have happened. So as we stand, we have only about 50 crores balance, which will also get finished in this quarter. And we've been aggressively bidding, as I've been saying, in the last 2-3 quarters. And the good thing, the encouraging thing is that at least 2-3 locations, we've emerged L1 totaling to about 1,000 crores plus. And we are looking forward to these orders, these converting into finite orders in the coming weeks. And our aim will be that we push quick deliveries so that these start generating revenue, at least if not by the end of this FY, at least by Q1 of the next FY. So then these will start contributing both to the top line as well as the bottom line.
Okay. And overall, as we've spoken earlier as well, the consultancy business is usually a high margin business, right? What's the plan with regards to growing that business going forward now?
Yes, in fact, that was our strategy to, as I said, minimize these two challenges. In the project consultancy wing, as I said, there's been a heartening growth both in terms of revenue realization from our existing orders as well as getting fresh orders. So as I said, year on year project consultancy revenue grew by about 20%. Sequentially also it grew by about 10%. We have been getting orders across sectors, whether it is rail infra, whether it is ropeways, whether it is metro systems like for Chandigarh cities, whether it is the environment mitigation plan, bridges, tunnels, etc. And this quarter we've got about 78 orders in consultancy, totaling to about 0.85 orders a day. So we are aiming to reach about 1 order a day in the coming quarters, as well as realized revenue from the existing order book.
Right. Rahul, another thing that just comes to our radar is, we are saying that the profit margin has moderated due to the change in mix of revenues, with exports being almost nil, higher turnkey revenue. But if we look at the second quarter consultancy revenue, which has increased by 5%, turnkey has declined. So why are margins lower when turnkey revenue has declined and consultancy, revenue has actually decreased? Because are we missing something there?
So you see, the total margins have slightly taken a dip because even in the inspection consultancy business, as we are trying to diversify and have more non-IR clients, the margins are definitely lesser than what they were in the previous year, where we were traditionally doing 60% of our business of inspection from IR. They had much higher margins. So now that is one area. Secondly, in consultancy also, there are certain sectors where margins are definitely tougher. So maintaining margins at the levels with more and more competitive coming across sectors, competitive arena coming across sectors, maintaining margins is going to be a tough call. So what we are trying to do is get more and more orders, increase the revenue so that at least there is a substantial growth in the EBITDA and the bottom line moving forward.
Okay. And my last question coming to you overall is with regards to the nomination versus competition orders, right? Nomination is 51%, competition 49%. It's still a very similar mix. Usually the margins are lower in terms of nomination. So is there any plan to increase the orders through competition and start reducing, what you get through nomination?
So, in fact, this breakup of 5149 is in the existing order book. But interestingly, if you see the fresh orders which are coming, as I said, about 78 orders came fresh in Q2. About 90% plus are on the competitive mode. So, as the moving forward, fresh orders with such a drastic change across clients from the old era of nomination to the competitive mode, we are seeing at least about 3/4 plus on an average basis moving forward on being on competitive basis. And that's the very reason why margins are going to be a challenge. Obviously, when you bid both in domestic and international consultancy on a competitive mode, the margins are going to be a challenge.
Okay. And from here on, what's the next milestone, Rahul, that you think that the company wants to cross from here on?
The first immediate milestone, in fact, we got the Navratna status a few weeks back. That was in our 50th year, as we enter our 50th year in April 24. This was a big achievement for us. And moving forward, one immediate milestone which we want to achieve is being a one order a day company. We've already reached 0.85 in this quarter, and I think one order a day is reachable, considering that we have about 13 different verticals doing consultancy across sector. And the second milestone which we are aiming at is generating revenue from the export stream on a steady basis in every quarter, which I think seems to be reachable again latest by Q1 of the next FY.
Right, so I think something we will be watching out for as well from here on, and let's see where the improvement comes in. Thank you, Rahul, so much for joining us on the show and sharing the views. So that's with regards to the management of rights. Clearly, there is some troubled waters that we are seeing so far in terms of where rights is concerned, and clear, and the stock price as well. It's been a slightly volatile ride, but in a 1 year basis, a little over 30% is the kind of gains that we've seen on the counter. But let's see what the roadmap has from here on. That's all that we have on this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to BQ Prime.